Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures are searching for direction, but under the surface, it's earnings driving the action. One of the key names we're watching is, of course, Tesla. The EV maker set to open lower as third quarter results came in mixed. The company posted better than expected revenue. Profit came in short. And CEO Elon Musk using the end of the earnings call to push shareholders to approve his $1 trillion pay package. That's up for a vote in just 2 weeks. Plus, airline stocks in focus. American Airlines flying high after the company reported a narrower loss than expected, and its profit outlook came in above estimates as it expects to see strong demand at the end of the year. Southwest Airlines also posting better than expected results. That company seeing the benefits of charging for checked bags. And more changes coming to Southwest next year. That's something I'll be asking the company CFO Tom Doxey about in just a few minutes and what that means for Southwest's bottom line. Plus, oil prices spiking this morning after the Trump administration ramped up pressure on Russia to end the war in Ukraine. The White House imposing sanctions on Russia's two largest oil companies, Rosneft and Lukoil. That could bar foreign countries or companies from doing business with those oil giants. Let's get a check-in on stock futures right now. We are seeing a little bit of a dip in futures, indications for a slightly lower open here. As we mentioned, we have that higher oil price. We have lower Tesla shares. We have a lot of other earnings coming out this morning as well. But we do want to dig more into the top story. Tesla shares taking some losses after the automaker posted mixed results for the latest quarter. While the company's revenue did top expectations, operating profit fell 40% from a year ago, and earnings per share came in shy of the street's estimates. Joining me now to break down those results, Yahoo Finance senior autos reporter Pras Subramanian. So Pras, what stood out from the quarter? I guess maybe that, there was that rush at the end of the quarter for people to take advantage of the tax incentive, but it wasn't enough to push them to profit or to bigger profit.
Yeah, I think that revenue number, $28 billion, was kind of a surprise, a 12% jump versus a year ago. I mean, that was fueled by all that buying that happened before the tax credit expiration. But you mentioned operating profit down 40% to $1.6 billion or thereabouts. So they were amping up sales, but cutting into their profits by just decreasing prices, right? So also want to know what's likely weighing on the shares here is the robotaxi progress, right? So in the earnings release, Tesla noted that they're operating a ride-hailing service in the Bay Area using robotaxi technology. It doesn't sound like Waymo, really, does it? So on the call, Musk brought it up and said that the current test in Austin, this is in the Austin area, will have safety drivers until the end of the year, and that's when they're going to remove them, being very cautious there. And that from an expansion point of view, they're going to expand to 8 to 10 metro areas by the end of the year, including Nevada, Florida, and Arizona. That's the states he mentioned. So those less permissive states might be easier to get that services going. California, maybe not so much, but I think there's a little bit of a downbeat sort of feeling after that, because I think there was more expectation that the robotaxi stuff would really amp up near the end of the year.
Yeah, and he sort of struck a more conservative tone, perhaps, than we're used to from Elon Musk. But at the end of the earnings call, he did make an appeal to shareholders to approve that potential pay package that could be worth as much as $1 trillion. This is what he said.
There needs to be enough voting control to give a strong influence, but not so much that I can't be fired if I go insane. And I think that sort of number is in the mid-20s approximately. Like I said, I just don't feel comfortable building a robot army here and then being ousted because of some asinine recommendations from ISS and Glass Lewis who have no friggin' clue. I mean, those guys are corporate terrorists.
So I believe he interrupted the CFO of the company to kind of go on that mini appeal rant, whatever you want to call it, Pras. But I mean, talk to us about the stakes here for that pay package.
Yeah, so at the end of the call, the CFO Vaibhav Taneja was doing his little wrap up, and he went right into the fact that the shareholder meeting is coming up on November 6th, and that shareholders should vote to approve the new pay package for Elon Musk, which they couched it as this thing to kind of keep him around, and he's a vital part of the team. Not so much mentioning the payout, right? And then Musk just jumped in, interrupted the actual Taneja's little blurb there, and said, yes, went off on this little sort of rant talking about how he doesn't feel comfortable building a robot army at Tesla without over 20% voting control. Started talking about how the founders of Google and Facebook, they actually have these super majority shares that he doesn't have because they went public before that. And he says this is all about protection and me being there, and not about, oh, by the way, it's $1 trillion of shareholder wealth going to him. So yeah, a little strange there at the end of the call. Look, I think everyone expects the pay package will still probably be approved, even though Glass Lewis and ISS said don't do it. Tesla shareholders, there's sort of like cult of personality there with Musk, and I think that's going to happen. But yeah, it was very weird to see them advocating for the CEO pay at the end of the earnings call. And maybe this comes up in the court case, right? In the appeals process. Hey, why are they talking about his pay package in the shareholder meeting? I'm sorry, at the end of the earnings call.
Right. Interesting that, yes. Yeah, we'll see what ends up happening in that court case. We'll be watching it closely in a couple of weeks. Thanks, Pras.
Thank you.
The jump in oil prices today could add more pressure than usual to bonds. Given the government shutdown, economic data has been sparse, so investors are taking cues from other drivers, and in this case, oil prices. The chart here shows the short-term correlation between the 10-year yield and oil. That's been rising since the shutdown, meaning when oil prices rise, we've been seeing bonds dropping. Joining us for more, Tony Rodriguez, Global Head of Fixed Income Strategy at Nuveen, which currently oversees $1.3 trillion in assets under management. Thanks for being here, Tony. Appreciate
with you.
So it is a weird time where the bond market doesn't have those usual cues from government data. So how are you reading that sort of reactivity to other factors like the oil market, for example?
Sure. So, it is interesting. We have a FOMC meeting next week, right? And we always go into those knowing that, sure, the future's uncertain. It's interesting this time is actually the past is uncertain too, because there's no data.
Right.
And the Fed has shifted to looking at the labor market, thinking inflation is near its peak and eventually will be declining next year. So the labor market data is pretty critical. Since they don't have that, you do have to look at some other indicators of what's happening with economic activity. The current oil price spike is clearly not related to economic strength, but to the sanctions that you referenced being talked about and potentially implemented. So the market right now, I think, is in a uncertain equilibrium, right? We've gotten kind of to the lowest levels of the year here. We think it'd be pretty difficult to see any further rally, but we're waiting on some catalyst to drive it either higher from here or lower. And really that's most likely to be the labor market data. And we don't know when we're going to get that.
We don't know. I mean, this government shutdown now is the second longest on record. There doesn't seem to be any movement. As you alluded to, we're at near the lowest levels of the year. I'm looking at the 10-year yield right now, which remains sub 4%. Do you think, even if it's not going to go much lower from here, do you think 4% is the threshold? We're going to be below it for a little while or around it for a little while?
It's interesting. Our view is that fair value is 4%. We thought we'd end the year at more like 4.25%. So we think there could be some very modest upward pressure from here. As we look into next year, again, 4% end of the year. The front end of the curve, like the 2-year, which is sitting a little under 3.5%, that we could see following Fed funds lower, maybe 3.25%. So basically, there's not a lot of total return left from a rate move in our minds in the fixed income market, but there are attractive yields you can earn. So you can get 4, 5, 6, 7%, depending on your quality positioning out of fixed income. But we don't think you're going to see double-digit returns because we get a big rally in rates absent there being a recession. That's not our call. But in that recession environment, then we could see much lower treasury yields.
And, again, if we were going into a recession, we might not even know right now because we don't have the data. I am curious, heading up into the government shutdown, we had a lot of conversations with people who were saying, well, we're going to be watching sort of the private data sources much more carefully. It hasn't seemed like there's been much reactivity in the market to any of those private data sources. So are you watching them, and what are we learning, if anything, about the labor market specifically?
Yeah, we are watching them, and what we're really seeing from the private side is very consistent data with what is kind of a softening labor market, not one that's falling off a cliff by any stretch, but certainly softening. So I think the risk is that if the Fed stays maybe too tight for too long, we could see a more dramatic softening in the market. And at this point, we've seen the unemployment rate go up about 0.9%, almost 1 full percentage point in the last year. We think that if we trigger above 4.5%, then it could become kind of a self-reinforcing storyline where companies see that weakness, a little bit of weakness in demand, cut some more workers, and all of a sudden you get a little bit of a sharp rise in unemployment, I think that's what the Fed's trying to stay in front of by going from kind of what we would call a modestly restrictive policy today to something closer to neutral over the next couple of months.
Tony, I know you're a fixed income guy, not an equity guy, but I am curious, given what you're just talking about, and that there is softening, if not falling off a cliff, the equity market acts like nothing. I mean, yes, you see some intraday volatility, but by and large, we are seeing, pushes higher there. And there's a lot of concern about speculation, a lot of concern about potential bubbles. What do you make of that as a bond guy, and how is that at all, if at all, feeding into the bond market as well?
Sure. Well, the valuation story is one of expensive valuations across all markets. You can look at, Bitcoin to gold, to equities to fixed income. So valuations are definitely elevated. Lots of strong demand for, all the markets basically. So it's really back to the fundamentals. When you look at that, corporate earnings have been steady, so that's supportive. You think about business investment, the kind of AI boom has really supported business investment. And as you look into 26, there's some hope for a little bit of fiscal stimulus, some regulatory relief. So that's why we think we avoid recession. We get to 2% growth. So we think that those valuations, which are expensive, we may grow into them over the course of 26 from the equity side. And on the fixed income side, the storyline is that since we're going to avoid recession, we have decent earnings, we're not going to see a turn in the credit cycle, a big sharp increase in defaults. So the valuations are, quote unquote, justified by the current level of fundamentals and strong technicals. So not a lot of upside from any risk premium reduction or spread tightening, but you can earn that 5-6% carry. And that should be a pretty attractive return when equity markets are likely to be in that mid to upper single digit return space as well.
Very quickly, Tony, you mentioned credit. Obviously, that's been a big topic recently with some high profile defaults. Yep. Is that something that you are at all concerned about?
I mean, certainly concerned about it in the sense that, are there more? So right now there was some fraud related to many of those. So we don't think it's a sign of broad deterioration in the credit market. But we do think that we're shifting into a market where you need to be more careful in terms of the actual fundamental underwriting that's taken place, because there are pockets of either speculation or weakness in parts of the economy that you can navigate. Navigating that will be critical in 26 versus what we saw over the last 2 years, which is basically that no matter where you put your money, it did well from a credit risk perspective. I think there'll be a little more differentiation as we move through the next year.
All right, Tony, thanks so much for coming in.
Good to be with you.
Coming up on Morning Brief, we're speaking with Southwest's CFO about the company's surprise profit in the latest quarter and its shift to assigned seating and bag fees. We'll be right back. Now time for some of today's trending tickers. We are watching American Airlines, Honeywell, and Dow. First up, American Airlines reporting a smaller than expected loss in the third quarter. The airline also now sees a profit for the full year. It had previously predicted a loss. The carrier joined rivals in predicting a strong end to the year as corporate and premium leisure travel drive growth. The stock now higher after the results. Year to date, American Airlines had declined 31% through Wednesday's close. Next up is Honeywell, reporting third quarter earnings that topped Wall Street expectations. The manufacturer also raised its full year profit outlook. The results were boosted by the company's aerospace unit, where sales jumped 15% in the most recent quarter. That division is expected to be spun off next year and will separate from the automation business. Honeywell also plans to spin off its advanced materials unit. That faced pressure earlier this year from activist investor Elliott, which took a $5 billion stake in the company. The new strategy will result in 3 publicly traded entities that are separate. And finally, Dow, the chemicals giant, seeing its earnings losses shrink in the most recent quarter. Loss per share falling to 19% compared to a 42-cent loss the prior quarter. Volume in its industrial unit improved from the prior quarter as well as new U.S. Gulf Coast plants came online. But Dow did report an 11% drop in packaging and specialty plastics revenue from a year earlier. That was due to lower prices for finished plastic products. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Southwest Airlines posted a surprise profit and record third quarter operating revenue as it continues to implement changes, including charging for bags and adding seat assignments. The airline expects the trend to continue, maintaining its full year outlook and anticipating record holiday revenue. For more on what's next for the airline, I'm joined by Tom Doxey, Southwest Airlines Chief Financial Officer. Tom, it's great to see you.
Hi, Julie. Good to see you again.
So let's talk about that unexpected profit. Analysts have been looking for a loss. You guys posted a profit in the quarter. How much of that do you attribute to this introduction of baggage fees? How much to demand? Break it down for us.
So we beat on cost and we beat from the midpoint of our revenue guide as well. And you're right, flipped from what was expected to be a modest loss to a nice solid gain. And that's everything from, you think of the different initiatives that we've rolled out here recently. It's everything from the bag fees to the amended deal that we did with Chase. These initiatives that we have are on track, they're working, and we're seeing that roll into earnings.
On the baggage fee front, have you all gotten any pushback at all from customers?
We track, as you know, Southwest, we pride ourselves on the interactions that we have with the customers, and we have seen our brand net promoter score return to levels that they were at prior to the announcement of some of these initiatives back in March, which is great to see. And, we've had a steady rollout of a lot of different initiatives in addition to bags as well. Things like free Wi-Fi, which rolls out this month in a partnership that we have with T-Mobile. New markets that we've announced. We announced Anchorage. We've announced some Caribbean markets. We've got new interiors that are rolling out as well. In-seat power, bigger bins, new lighting, extra legroom seats, which we started selling in July that will start operating at the beginning of next year. So there's a lot happening here, and it's, I think, really resonating with our customers.
I have just, out of curiosity, a process question. When you've never charged bag fees and you start charging bag fees, how does that change what bags people bring? Are you seeing people bring fewer bags, for example?
It's almost exactly what we would have expected, yes. So as you charge for bags, of course, there's revenue that comes in for the bags that are checked, but we also assumed that we would have a reduction overall in bags, and we've seen that. So that's about a 1/3 reduction in the quantity, which is right in line with our expectation there. And that helps our operation as well. So that helps us to turn airplanes more quickly and just sort of streamlines things for us, what we call below the wing.
Tom, as you mentioned, you're doing a lot of other changes, including changing your seating process. That changes effective late January for stuff that people are booking now. That must be a big sort of internal infrastructure change. What's the biggest thing you guys are focusing on there?
It is, and we started selling that back in July, and that's for flights that will be at the end of January and beyond. And so we're starting to see those sales come in. Everything is as we would have expected. And when we think of those that are choosing not to fly us today, I think this is a really interesting stat. 85% of those who have chosen not to fly us today, they say that it's the boarding process and the lack of assigned seats that is the number one reason. Of course, we want to eliminate any reason that somebody has not to fly on the airline. And so we're really excited, and this is resonating with people. We're seeing it in the sales numbers so far. As far as processes, there's a new boarding process that we'll have that I think will look similar to what customers are used to with other airlines. But more than anything, it's that assurity that you have that when if you're the first person on the plane or the last person on the plane, you know what seat you're going to be sitting in, and I think that'll really resonate with both our current customers as well as those that are choosing not to fly us today, which I think will start to fly us a bit more than they had in the past.
Right. Well, they're used to it elsewhere, certainly. Tom, the fourth quarter forecast for record operating revenue, unit revenue to rise 1% to 3%, and you all mentioned in the release that includes factoring in the effects of the government shutdown. So I'm curious what your sort of base case assumptions are around the shutdown that you're factoring in there.
Yeah, it's relatively modest, and so I think that was just sort of a minor comment that the modest impact that we're seeing now is included within the guides that we gave. So far, no major impact relating to the shutdown.
Do you have sort of a worst case scenario, though, that you're also preparing for? Because that shutdown, it's not showing any sign of ending. We have started to see some signs of stress in the system. As the air traffic controllers maybe are not getting paid, we might see more sick out. So how are you all preparing for that potential?
Yeah, so first off, you mentioned those that are out working. I want to make sure that we thank those. those folks that are out there, not receiving pay for the work that they're doing. They are professionals. They are incredible. Please thank them as you're traveling for what they're doing. As far as what we're looking at, again, everything that we've seen so far has been really modest and is contemplated within the numbers there. Of course, we'll continue to monitor and see if we see further impact, but so far, everything that we're seeing is contemplated within our guidance.
And finally, Tom, I'm curious just in general what you guys are seeing in terms of demand. I mean, implied in the numbers is sort of that demand is going to grow to some extent, but can you give me a little color around that and whether you're seeing any pockets of weakness?
We saw an inflection back, positive inflection in July, and that held quite steadily through the quarter. Again, I mentioned that we had a beat on revenue for the third quarter, and so that strength that we saw in July contributed to that, of course. Our assumption as we go forward into the fourth quarter, continue through the fourth quarter, is that same revenue environment continues on. And you think about some of the things that we've already announced. I think another thing that's really exciting for us, we have been not so subtly hinting at future potential product items that we're looking at. Things like clubs, things like first class, things like international. Nothing to announce today, but we are continuing to evaluate those things as we look at some of the premium revenue streams that the other airlines have had the ability to participate in. Those types of things at least need to be considered as we move forward so that we have that potential to participate in those more premium revenue streams as well.
Tom, great to see you. Thanks for your time this morning.
Thanks, Julie.
And before we head to break now, we want to bring you some breaking news on Supermicro. That company is pre-reporting its results here, and it's pre-reporting results that are well below what analysts had been anticipating. The company says preliminary first quarter net sales is going to come in at $5 billion. Analysts had been looking for about $6.5 billion. The shares are only down a little more than 1.25%, which is interesting here. They had initially fallen quite sharply by around 10% and then recovered some of those losses. The company still says it sees strong demand for Blackwell Ultra. That is the NVIDIA chip, of course. And the company says it is, in the statement, saying it's seeing outstanding levels of customer engagement for newly released AI liquid-cooled solutions. That's one of the things that Supermicro does. They said we see customer demand accelerating here, reiterating revenue of at least $33 billion for the full year of 2026 with expectation of delivering more. So the fact that the shares are not down as much as they were earlier might reflect that confidence in the longer term, even as in the shorter term here, we are seeing a little bit of weakness versus what was expected. All right, that does it for Morning Brief.